I want to talk to you about B2B payment processing. So we are speaking about business to business payment processing. So here are the facts I want you to really pay attention to. The thing is that the main difference between B2B and B2C payments lies in who is paying who, right? It's all about, businesses pay each other versus businesses paying a consumer or vice versa. So B2B payments are not too different from B2C payments, whether it's cash, credit cards, or electronic funds transfer. The main differences lay in the let's say the actors here. So the recipient, but also the originator. So B2B credit card payments are just one branch of the credit card processing tree. So this is very important to think about that. Now, let me first introduce you to a B2B so you have a clear idea what I'm speaking about. When you think about the global B2B market, you are looking at $18 trillion by the end of 2026. Think about that. $18 trillion. Okay. So B2B payments are massive and are common in many industries, manufacturing, tech, and the wholesale industry being the top three biggest B2B industries. Okay. So if you're looking for a quick and easy way to take payments from other businesses or even streamline your payments, you want to really pay attention to this video from A to Z because I'll be giving you a few hacks, a few tips, a few tricks to really streamline the B2B payment process for you. Let me first do a quick compare and contrast between a B2B payments versus a B2C payments. So the main difference between B2B and the B2C payments is actually the direction of the payment. So while both involve businesses receiving payments, B2B transactions are when a business pays another business, creating a business to business relationship, right? So that means what? It means that you have maybe contractual agreements, you have operational agreements, but you also have a heightened sense of customer service because the expectations for customer service are higher if you are dealing with a business. Okay, so this is important to really talk about. So that's for a B2B. B2C, on the other hand, are transactions that take place between a business and between a business and individual consumers, creating a business to consumer relationship. So when businesses go about paying one another, it's usually different from the traditional checkout experience consumers are used to. So businesses often deal with large orders and they do not typically visit the physical location or storefront, if there is one, of the business they are dealing with to actually make a payment. Usually it's something on the phone, really, if you think about it that way. So let me talk about the gateways here. When you think about B2B payment processing, there are actually there are ways for businesses to pay each other. So I want to share with you the top three ways that businesses are paying each other this year. First, you have ACH. Next, you have credit cards, and then you have check. So when you think about ACH, ACH stands for Automatic Clearing House, and this is the term used to describe the electronic transfer of funds in the U.S., also known as a pre-authorized debit in Canada. And in Europe, the terms are different, okay? So ACH payments are bank-to-bank payments. They use businesses or customers' financial institution financial institution information rather to directly pay a business for, let's say, a product or service. So the fees are lower than credit card processing fees, but ACH payments take longer to process, usually between 1 to 3 days. And there are some industries where the time is actually 5 days. So ACH payments lets you use your bank account to make payments instead of using a credit card. So while many online payment platforms currently rely on credit cards for transactions, ACH is really gaining momentum and is likely to become increasingly available for online payments in the near future, especially when it comes to B2B transactions, okay? So that's the first thing, ACH. Next, you have credit cards. So credit cards are not just for individual consumers, but also an incredibly powerful tool for many businesses in many industries. Think about it. Banks and credit unions issue business credit cards for a reason, okay? So making big purchases is easy with credit cards as you don't need to deal with a large amount of cash or wait for a check or ACH payment to clear. And a credit card transaction is actually immediate and can be done online through a payment gateway or processed over the phone. So that's pretty good. Next, we have check. So the good old-fashioned check is a tried and true payment method for businesses. And though the word on the street is that checks are going away for good, many businesses still insist on using them, and they do not appear to be completely retired yet. So the downsides with checks are rather obvious. They take a while to send and process, and you need to hope that when you give another business a check, they deposit it in a timely fashion. Otherwise, you can end up with cash flow issues. So that's important. Let me give you some pertinent information here. So when you think about B2B payment processing, there is a contextual sort of consideration to really pay attention to. Let's first talk about recurring billing for B2B payments. Maybe you have a relationship with a business, and you expect them to actually pay you regularly because the transaction is set up in a way that they have to pay you every month or every quarter or every 6 months. Okay. So recurring billing is very popular among business owners transacting with other businesses. And an example, let me give you an example. An example of businesses needing recurring payments would be when wholesalers or contractors ordering supplies on a regular basis. And like if you are in the construction industry, for instance, you have tools that you need for work, right? So those tools, you are ordering them every single month or every quarter on a regular basis. So recurring billing can be done in different ways. In the past, it was not automated. Today, and that's a big transformation. Today, recurring billing can be done electronically, but also via EFT. I'm speaking here about ACH, PAD, or credit card. So you have a lot of options to automate everything. So that's really good. And all your business needs to set up a recurring billing cycle with another business is actually the purchasing business's credit card or banking information. In other words, the account number and also the routing number. So if you use a payment processing software tool, once a billing date is agreed upon, you can simply set it and forget it, and everything will happen in the background, and your cash flow will be taken care of, and that's pretty good. And one thing I want to say about recurring billing is that, of course, there has to be a certain level of trust vis-a-vis the other, vis-a-vis the counterpart, right? The business that's really paying you on a recurrent basis for you to actually set up the recurring billing process and for the whole transaction to work too. I mean, you do not want to have like to call the customer every month and say, how come the bill didn't go through, that kind of stuff. I want to talk to you about processing fees for B2B transactions, because the whole thing is that you have fees that are sort of involved in a B2B sort of process. So B2B transactions generally have a lower credit card processing and interchange fees compared to B2C transactions. So the Federal Reserve Payment Study on Consumer and Business Payment Choices concluded that an average B2B ACH debit transaction was $31,118, while a B2C transaction averaged actually $44. By the way, it was $31 and 11 cents. So that's the average. Okay, for B2B ACH debit transaction. So for B2C, the cost was $44. So you can see that there's a big delta there. So it's really important if you are going to, let's say, invest in B2C, B2B transaction modeling to be clear about the cost. So understanding that B2B transactions are less frequent, but involve significantly larger sums of money per average transaction than B2C transaction is actually crucial in understanding why credit card processing fees vary for both types of transactions. So the more money a business processes, the more they need lower processing rates to be able to afford to take such a large sum of money, right? This is actually this had to do with economics 101, economies of scale. So this is important, and of course, the if you have transactions on a less frequent basis, of course, the chance for fraudulent activities is also reduced, right? Compared to you having 1,000 transactions for $15 versus having one transaction for $15,000. You can see the context is totally different. So there is more risk. There is a heightened sense of risk if you have like let's say you have a large amount of transactions. Even when you have transactions, it doesn't matter the amount of the monetary amount. It's actually the frequency of the transaction that really creates the like an environment for risk. I want to talk to you about credit card data processing. So when you think about B2B payment processing, you have three levels of credit card data processing, and I want to really introduce you to those three levels. So let me first talk to you about level one. So basically, level one processing is actually used by a vast majority of merchants that sell to consumers, and this is actually level one is actually the most common type of credit card processing, and most small to medium-sized businesses fall within this level because card networks like Visa and MasterCard require merchants to process at least $1 million in annual transactions to actually move to level two. So level two is kind of complicated for small businesses. So level one, you have a $1 million threshold. So level one requires the following data to be collected and submitted per transaction. So you have to actually collect and submit this data to the card networks, to American Express, to Discover, to MasterCard, and to Visa. So there are four types of information. So you have the total purchase amount. You have the purchase date. I'm going to put this on the screen so it's pretty clear to everybody. So you have total purchase amount, purchase date. You have the billing zip code, and you have the merchant name. And of course, Discover, American Express, Visa, and MasterCard are using this for statistical purposes, but also for data tracking purposes. If ever there was a problem, let's say the client was not satisfied and there was a chargeback possibility, this data will provide all the intel the card networks will need to actually process the complaints. Okay, so don't forget, if you are at a level one credit card processing level, you have to submit those four data points: total purchase amount, purchase date, billing zip code, and merchant's name. Now let's talk about level two. So by switching to level two processing, you as a merchant can see considerable discounts on interchange fees due to the higher quantity of sales that you process annually. Okay, so basically, even though merchants can continue processing as level one, even after surpassing $1 million in transaction, there is a reason to do so. And so basically, by the way, it's not $1 million. It's actually 1 million annual transactions. Okay, so level one, it's actually a 1 million annual transactions, and level two, that's when you surpass 1 million transactions. So, in fact, merchants will be paying higher interchange fees with level one compared to level two. Let me break it down for you. So, level two transactions are eligible for businesses that process between 1 to 6 million transactions annually. So the focus here is not on the dollar amount. The focus is on the count, the transaction count. So level one, 1 million maximum. Level two, 1 to 6 million transactions. So level two actually requires the following data. I'm going to put this on the screen so you can really remember that. So basically, level two requires the following data to be collected and submitted per transaction. So you have the total purchase amount, the purchase date, the billing zip code, the merchant's name, the tax amounts, the merchant tax identification number. This is also called EIN, employer identification number. You have the invoice number, you have the order number, and then you have the customer code. So you can see that the extent of data required at a level two is more convoluted, is deeper and broader than what you have at level one, and that makes sense because you are speaking about a larger count of transactions, which really increases the possibility of fraudulent activity. So the card networks, including American Express, Discover, Visa, and Mastercard, want to have more granularity in terms of the data, just in case if they have to go after something or they have to verify something, at least they have all the info they need. So if you're looking for B2B payment processing, I want you to really consider level two, level three. So level one, less than 1 million transactions. Level two, between 1 and 6 million transactions. Now let's talk about level three. So level three requires the most data collection. However, eligibility for level three is not really contingent on the volume of transactions, but rather on the ability to collect the additional data that I'm going to mention to you very shortly. So processing level three data can get interchange rates discounted even further. But the main key feature is actually reduced fraud risk, and additional monitoring for safety, accountability, and compliance. Okay, so level three requires the following data to be collected and submitted per transaction. So level three, you are looking at more than 6 million transactions every single year. More than there is no upper limit really. So here's the data. You have total purchase amount, purchase date, billing zip code, merchant's name, so that's important, the tax amount, the merchant tax identification number, so again, the TIN, the EIN, the invoice number, the order number, the customer code, the product SKU description, that's important for the card networks. You have the product code, the unit price and the unit of measure, the unit quantity. This is kind of important. Also, discounts applied and the line item total. You have debit and credit indicator. You have the freight and or shipping cost. So the card networks want to have a clear idea about that. And also you have duty and or import taxes assessed. Okay. So final thoughts here. Although not all that different from B2C payments, the tools and processes that I mentioned to you a little earlier will help your business take your payments with other businesses to the next level without having to worry about crazy high processing fees, especially if you do things in a streamlined manner. If you really make sure that you speak to maybe you first do a little bit of due diligence around the payment processors and see what they have, and then really have a phone conversation with them. One thing for sure, if you're going for a B2B payment processing, you have to really talk to a payment processor, but in a lengthier manner. You can't just have a phone call and that's it. No, there has to be a series of conversations via email and phone calls before you make a final decision. So here's the epilogue to this conversation. I spoke to you about B2B payment processing. I'll give you the facts, the gateways, some pertinent information, and credit card processing. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.